Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Nordic American Tankers stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Nordic American Tankers is an oil tanker shipping company. It has 86 ships with a total capacity of 2.2 million deadweight metric tons. The average age of its fleet is 9.2 years, which is older than most other companies in this industry. The company is headquartered in Bermuda and was founded in 95. It started trading in 97 and can be found on the New York Stock Exchange, London Stock Exchange, and Deutsche Börse. The company has only one type of vessel, the Suezmax. Having one type of vessel makes this company more efficient than if it had multiple types. Just like Southwest Airlines only has one type of plane, it makes their operation more efficient because they know exactly how much of staff, how much gas, and how much their overhead will be. The Suezmax is the largest ship capable of passing through the Suez Canal. Some super tankers are too deep to fit through and either have to unload part of their cargo to other ships or to a pipeline terminal before passing through. Or alternatively, avoid the Suez Canal and travel around Cape Agulhas instead. The Suez Canal was deepened in 2009 from 18 meters to 20 meters. This article says the company will charge $17,000 per day for a 40 to 60 day trip. They also signed another contract for $17,000 per day for a 6 or 7 month trip. The average operating cost is $8,000 per day for its ships. Some reports indicate the rates companies can charge is $4,000 to $5,000 per day, which would mean tanker companies would lose money each voyage. If the $17,000 per day number is accurate and will be the rate for future voyages, then the company should be really profitable this year. The going rate for a voyage is dictated by the spot market, not by the individual company. The supply of ships in the market is highly correlated to the profitability of these shipping companies. The cost to maintain the ships is fairly fixed, depending on the age of the ship. The revenue each ship receives can vary a lot depending on the number of ships in the market. There will always be demand by companies looking to transport oil across the ocean. To transport oil within the US or any country, it is usually done through pipeline. Transporting oil between two countries like Canada and the United States is also done through pipeline. And if you want to transport oil from a country like Africa to the United States, if you did it by plane, it would be way too expensive because you cannot fit that much oil on a plane. Shipping oil by vessels is the only viable option. Also, after about 10 years on average, a ship gets scrapped. When the number of ships in the market falls, then the remaining ships are able to charge more per delivery. When a shipping company makes a lot of money, they usually buy more ships to keep growing. When the number of ships in the market gets too high again, the shipping companies are unable to demand higher prices anymore. This vicious cycle seems to happen quite often in the oil shipping industry. You almost have to figure out when the supply of ships is low and invest in tickers like NAT, EURN, STNG, DHT, TNK, INSW, and FRO. When the supply of ships grows, then you need to sell your shipping stocks. Also, when supply of ships increases and companies lose money, some corporations are squeezed out of the market or are forced to merge, like International Seaways and Diamond Shipping did recently. It does appear oil shipping stocks are getting to a really low point, and an upswing seems inevitable. Trying to identify the bottom is almost impossible. Some people have been sitting on these stocks for months or even years, watching them lose value. I know that it can be really devastating and stressful because when a stock goes down, it seems like it will keep going down. And when a stock goes up, it seems like it will keep going up. You have to separate your emotions and just focus on the long-term plan. This company's average fleet age is 9.2 years, which is higher than most oil shipping companies. Older vessels are usually less fuel efficient and more costly to maintain. Cargo insurance rates also increase with the age of a vessel. As vessels age, market conditions might not justify the added expenses, so scrapping the ship may be the best option. If you scrap enough ships, you may be forced to buy or lease more vessels, which, as you know, are very pricey. Just something to consider when investing in a company with older ships. Another thing to consider is the price of steel. Since steel prices are at an all-time high, then scrapping old ships may make more sense because the scrap value is higher than when steel prices are low. When steel prices come down, then purchasing new ships is a smart move. You may want to try investing in companies that need to scrap old ships when the steel price is high, like now, and invest in companies that need to buy new ships when the steel price is low. The higher the steel prices are, the more likely a company will scrap its old vessels which will decrease the total ships in the market, leading to higher profits for all oil shipping companies. If steel prices doubled, for example, I would invest a ton of money in these companies because lots of old ships will get scrapped and new ships would be too pricey, so less people would buy new ships, which means the total vessels in the market would decrease dramatically, resulting in amazing margins for oil shipping companies. Let's get started with the model. This is a small cap company, 409 million market cap. They're trading at $262 a share and they have 156 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have negative free cash flow in 2018, positive after that. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was positive in 2020, negative in the other years. Revenue is the sales for the company, and that peaked in 2020. It's at its lowest point in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. So their revenue is really dictated on the spot price in the market. The price per day peaked in 2019 and was pretty high in 2020. That's why their revenue was so high those years. It came down a lot in 2021, and it was also pretty low in 2018. So the number of ships is pretty static year to year. It's just how much they can charge per day. This is a commodity market. You can't charge higher rates than your competitors by marketing a lot or conveying to your client that we have the best customer service. It doesn't work that way. The rates are the rates. There's not much differentiator between the companies. It's not like buying a piece of jewelry where you can make it really fancy and nice or the name brand makes a difference. Your profits are dependent on the rates in the market. And as ships decrease in the market, the rates go up. So the total ships in the market was probably low at this point. As companies bought more ships, the spot price came down. Because the demand for oil is pretty much always going to be there, and the price of oil doesn't make too much of a difference. The only time the price of oil makes a difference for this company is in their cost of revenue, because they have to put oil into ships to commute them. If oil prices are $50 or $100, there's still going to be demand for oil, so these ships will still have demand. And you can see their cost of revenue has decreased over the years. I would expect their cost of revenue to be pretty static, but it has decreased. Their operating expenses have increased. Some companies put an expense in cost of revenue, while another company will put the same exact expense in operating expenses. In terms of your total profit or the taxes you pay, it doesn't really matter where you categorize your expenses. But categorizing your expenses does matter for people like us investors who want to learn about the company. This is a Bermuda-based company, so for some reason, I have a hard time understanding the financials for non-US companies. The same thing when I look at Canadian financials. I just have a hard time finding all the information. I'm not implying they're doing anything wrong. Maybe I'm just not used to the way things are laid out. So they do have positive operating income every year, except in 2018. Their revenue was $20 million higher in 2018 when compared to the trailing 12 months. But in 2018, they had negative $30 million of operating income. In the trailing 12 months, it was positive $15 million. That's why I like to look at cash flow from operations. It removes all the accounting items. They did pay $25 million of interest on their debt, which was the lowest amount they paid in the past few years. Since they're based in Bermuda, which has really low taxes, and they have negative net income most years, they pay almost no taxes. So the bottom line of their income statement is their net income, which was only positive in 2020. This is their total fleet by years, and they bought 8 ships in 2019, 9 in 2020, and 2 in 2021. So maybe that's why their cost of revenue is lower, because in 2018, maybe their average age was a lot higher than it is currently. And the older the ship, the more expensive it is to maintain. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they generated positive operating cash flow every year except in 2018. So even though they had negative net income in the trailing 12 months, they still generated $60 million from their operational business. And then you have capital expenditures, which are investments in property, plant, and equipment. They spent $18 million in CapEx in 2020. The vessels they buy are really expensive. They can range from $20 million up to $100 million. Maybe the $18 million was a down payment, and they just financed a ship over a certain number of years. Operating cash flow minus CapEx gives you your free cash flow, and they do have positive free cash flow every year except 2018. They always pay a dividend. Even during coronavirus, they paid a dividend. They have cut their dividend, But that's mainly to be more in line with their stock price. They pay over 3% dividend yield. And every year they pay down stock. They paid down $80 million in 2018. They added $300 million in 2019, but paid down $334 million. And they paid down $75 million in 2020. They also added some capital stock, $18 million in 2019 and $21 million in 2020. When a company adds capital stock, that increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. $577 million of equity, $351 million of debt. They're 62% equity, 38% debt. Their net debt is $313 million. Net debt is debt minus cash, and their WACC is 7.11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.2 billion. We divide that by 156 million shares. And we get a calculated stock price of $7.80. They're trading at $2.62, so they're trading at a 66% discount. It's a strong buy according to the model. Simply Wall Street is in the other direction. They're saying the stock is worth $1.15 a share. They're saying it's really overvalued. 4 analysts priced this stock, and the average price target was $3.69. So if you bought this stock when it started trading, you could have made a great return because it looks like it broke through $55 a share at one point. But since then, it came down a lot. It did have some peaks along the road, but overall, it's been really struggling. This is the stock price the last 12 months. So you can see it's at a pretty low point. It just keeps going down. So if you are bullish on this stock or this industry, this may be a great entry point. But if you're bearish, just don't buy it. They cut their dividend from 20 cents to 2 cents, but they're still paying over 3% dividend yield. They pay out 30% of their free cash flow. That gives them 70% remaining to grow the business. So it looks like they should be able to maintain that 3% dividend. And I think there's a decent chance they'll even raise it if their profits increase. And this stock is not too volatile. It has a beta of 0.61. The stock has gone down 41% in the past 52 weeks, while the S&P 500 went up 36%. The 52-week low was 259, the high was 478, and the stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. Over 2 million shares are traded each day on this stock, so it's pretty liquid. Of the 156 million shares outstanding, 149 million are on float, 31% are held by institutions, and over 3% of the shares on float are shorted. In the past year, this stock is down a lot compared to its industry and the market. Same thing in the past 5 years, this stock has really struggled relative to its industry and the market. But 3 years ago, it was at its lowest point, so it's actually up 37% from 3 years ago. If you bought the stock 3 years ago, last year you would have been up 300%. But if you're still holding from 3 years ago, you're up only 37%. Analysts are really bullish on this stock, projecting their earnings to grow 140% and projecting their revenue to grow 10%. In the past 5 years, their annual earnings increased 5% on average, but in the last year, their earnings decreased 162%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be really unhappy, down to $2,700 today, a 73% loss. The biggest shareholder is BlackRock at 6%. The CEO of the company owns 3% of the stock. So if you like owning stocks where the CEO or management owns a lot of it, so your interests are aligned, this would be a good candidate. Morgan Stanley owns 3%, then Wells Capital, then State Street. Let's look at their financial ratios. We can't look at the PE because they have negative net income. They have a really good price to sales ratio, so they are bringing in a lot of revenue relative to their market cap. Investors are paying $1.50 for $1 revenue, and they have a great price to book ratio. It's below 1, so that means their equity is higher than their market cap. So if they shut down a company, sold all their vessels, paid off all their debt, they will be able to give each shareholder $3.70, which is more than it's trading at. So the company is worth more in bankruptcy than active. Of course, you don't invest in a company so it goes bankrupt. But it's good to know they have a lot of assets on their balance sheet in case they need to sell those assets and get through some difficult times. They have a really low return on invested capital at 1.7%. They can cover only 60% of their interest payments with their EBIT. Their ROE is negative. They do have a lot of current assets on their balance sheet, and their quick ratio is also above 1. They have $24 million of inventory. I'm not sure what the inventory is, but at least they have $38 million of cash, which is almost as much as their current liabilities. And the company does seem to be well capitalized. They had $42 million of free cash flow in the trailing 12 months, $47 million of working capital, and they pay out $12 million of dividend payments, so they have $77 million of excess funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Castor Maritime, Synergy, and Tops. all in the same industry as Nordic. And if Nordic has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. All the companies have negative earnings, so we can't look at their PE ratios. That's because the spot price is so low in the market, they're all losing money. But this company has the best price to sales ratio, best price to book. They have a good current ratio. Of course, everybody has negative ROE. They're lowest in debt, and they're the biggest company on this list, and they're the only ones who pay a dividend. Even though there's always going to be demand for their service, some companies will be forced into bankruptcy or will be forced to be acquired by another company if they can't get through times when they have negative profits. So Nordic is in a good position to gobble up some of these other companies, especially Tops and Ship that have so much debt. And Nordic is about the size of these other three companies combined. So if you're bullish on this industry, this would be a good stock to buy. So to summarize, I have them trading at a 66% discount, but this is a really rough industry. It's not hard to figure out how to make money. When the total number of vessels in the market decreases, then the rates go up, and the companies that are currently active make good margins. But who knows when the number of ships will decrease? And you can make a lot of money with these companies. You could 10x. But if you put $10,000 into a company, and after 5 years, your $10,000 was $3,000, you'd have a hard time stomaching that day after day. Even if I told you, don't worry, it will 10x, and say it went from 3,000 to 30,000 in the next 3 years. But the problem is, who can sit and hold that many years with that much losses? It's really hard to do. And also, you have to pick the right company, because if your company goes bankrupt, then you might lose everything. You got to figure out which company will be active in this industry in the next decade or so. Maybe none of the companies will be active. Maybe a new company will gobble up everyone and take over. I rank their free cash flows 5 out of 10, their revenue 5 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.